National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
On today's show, our expose on Indexed Universal Life with industry consultant Bobby Samuelson.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And today, industry consultant Bobby Samuelson, supreme blogger, I must say. What can I say? Bobby, welcome to the show.
Thanks for having me.
Well, people say, Bobby, we've seen your articles, your blogs, some little bit of video, hopefully we'll help you on that.
Yep.
We're talking today about an expose on an index. It is the hottest product, I'm sorry, it just is.
No question.
And you know what, we try to understand it, we try to get our hand around it. You pontificate on this, you are very technical. Now remember now, you're with Steve, the simplistic boy today, so you gotta kind of keep it down, you know. But we wanna walk into a few things about indexing today to talk about it from a mechanical point of view, because everybody is saying things that are absolutely not true. And I want to be able to kind of bring some truth serum to the show today and bring a little bit of gravity, bring us down to earth, you know, because you know we're illustrating. Let's just start there.
Right.
We're illustrating. I got guys that are illustrating 8.3% because the look back by the carrier said they could.
Right.
Let's talk about that issue first, because I know it's controversial, right?
Yep.
Some carriers know it is controversial and they still let them do 8.3.
Yeah, so that's a huge issue. And I'd probably start off by saying, first of all, why does an illustration matter? Mm-hmm. And I think that's the big question we ought to be answering first and foremost, which is, you know, if I show you an illustration at 5%, and I show you an illustration at 8%, is the 5% illustration a better reflector or worse reflector of future performance than an 8%? Who knows, right?
I don't know.
And not only that, the illustrated rate makes no difference for actual future performance. So the first thing we ought to get off of before anything else is that showing an 8% illustrated rate is in any way indicative of future performance. Mm-hmm. It's not. It doesn't have any impact on the performance of the contract. And so instead of saying, well, I should be spending a lot of time trying to figure out the right illustrated rate, you should be saying, is that illustrated rate meaningful or not? And I would argue that it's not meaningful. You ought to be showing it at whatever illustrated rate, you know, low, high, whatever it is, and telling the client, look, I have no idea what the future performance of this contract is. So like I said, instead of trying to get to the right number, instead make a value judgment on the illustration itself. Is it important? And I argue no, it's not important, the illustrated rate itself.
Well, when I think about illustrative rates, I mean, I have an article coming out in about 2 weeks called, talking about proposals, and the title of the article is called Vapor on Paper.
Yeah.
I don't know, but isn't it true that the designers, the architects of indexed UL are predicating basically their profitability and the return about 200 basis point above the current assumption UL?
Yeah, so you said two words, right? There's and predicating and profitability.
Oh, I thought you were going to say vapor on paper.
No, but it is a great title. So you know, the designers of these products, the actuaries, the guys who are back there actually building them, they don't really care about what the future returns are going to be. So from their standpoint, the way that they build these products, if equity markets go up 20%, that is no more or less profitable for them than if equity markets go down 20%. And the reason for that is because they actually take all the equity risk and pass it off to a third party, typically an investment bank. So in terms of designing a product to perform at 200 basis points more or anything like that, that's really not their goal. What they're really worried about is making sure that they can actually transfer that risk from their balance sheet to somebody else and do it efficiently. And what happens when they do that is they essentially transform an IUL product into a current assumption product. So they don't care whether it does 8%, they don't care whether it does 3% or 5% from a profitability standpoint.
So they're already priced all in.
They are priced all in because all they do is, like I said, push that risk off to someone else.
All right, well, let's stop right there. Who is the someone else?
So the someone else, actually it's pretty interesting. So the someone else.
I fear asking that question.
Yeah. No, the someone else is typically investment banks. And it's both domestic and European investment banks. And what was actually interesting is from 2007 to 2008, carriers were trading a lot with domestic investment banks. And actually they traded a lot with Lehman, believe it or not, Lehman and Bear, to back these types of products. And when the financial crisis hit, they went overseas to the European banks. And what's happened with that, right? Wow. So essentially they're going to the same investment banks you read about in the Wall Street Journal, and those are the guys who are taking the risk for these products. The only risk the carrier has is if they promise you a 12% upside, you know, and a 0% floor, that costs them something to provide it. So it probably costs them on the order of 5.5 or 6% to do that. and they've got to make sure they can afford that. So the only issue is, can we pay enough to cover what we promised? So when caps fall, all that means is that the cost to hedge it went up, or the carrier has less to spend on the hedges.
Well, when I think of caps, I mean the leading indexed industry, and I looked at this last night before prepping for a show that I'm doing next week. I'm looking at 17% cap. That's a big cap, and 100% par participation rate.
Right.
So that is like a magnet. You know, most agents, that's like flies to a to a light. You know, and I look at that and say, wow, 17%, 100% participation. That's the best contract.
Yeah.
Is
yes.
it?
Well, it depends on who you ask, right? The carrier, I'm sure, says.
Well, that's why we're asking you, Bobby, because you're the industry consultant, right?
Right. So you know, my thought on these sorts of things is caps are a function of policy charges. So high policy charges mean you can offer a higher cap, and they're a function of this hedging formula that I've
Let's
kind of
stop
alluded
there
to.
because there's another issue. I don't want to keep going by anything because I know my guys are asking, all our guys and gals out in the audience are asking the same thing I'm asking. Well, they're covering their higher expenses. When you mean higher expenses, do you mean indexed chassis inherently have higher expense loads than their current assumption UL counterparts?
Yeah, so it's not really an inherency issue. There's no reason that says that IUL should necessarily have a higher set of policy charges than current assumption UL. But typically what's happened is both because the commissions are higher on IUL products and because there's some complexity with the crediting rate and because offering all this upside costs more money, they tend to have just higher policy charges. And the way that essentially works is if the carrier needs to, let's say it's earning 6% and it's going to be spending 5.5 to 5.75 to provide that 12% cap or that 13% cap, then because they're making less of an investment spread, they pack in higher policy charges. So it's not that it's unfair to the client because they really do get more upside, but the policy charges themselves are a lot higher. So when you say a 17% cap, that 17% cap may mean that the carrier has really high policy charges, and so the actual dollar per dollar performance of that contract for a 17% cap may be equal to a lower cost policy that has a 10% cap. So basically, instead of just looking at the cap, you need to be looking at both sides of the equation, not just the cap, but also the policy charges.
So if you had to break out the interior, and I have a lot of agents that don't know this, so I think it's a good time to talk about it. I know we have cost of insurance, but is that going to be any different on the index platform than it is on the current assumption?
Yeah, so that's what's actually pretty counterintuitive, which is that in theory, the mortality cost for IUL should be identical to current assumption. Yeah, totally. So the reason why it's not is because you can cover up a lot of mortality charges if you're showing an 8% illustrated rate.
Well, then why is the underwriting not much more benevolent?
Because it's a lot more complicated than that, right? Because remember, they're providing more upside and they're still charging you more for it. So from a profitability standpoint, the two products may be the same. So cost of insurance is one thing, and they are more expensive in IULs than current assumption ULs pretty much across the board. And there are some current assumption products that have high charges too, but on average, IUL products are about 50% more expensive than current assumption products.
All in or COIs?
All in over the life of the contract. Now, in terms of other policy charges, carriers have moved more to a per thousand charge in the first 10 years. That's a fixed charge per $1,000 of face amount. And those policy charges are generally higher on IUL than they are on current assumption UL. Premium loads are pretty comparable, and those are kind of the three main factors that you find in pricing. So again, COI is more expensive, per thousand charges more expensive, but not always. Although some of them have really high policy charges. Some of them have policy charges that are 2 or 3 times as high as you'd find in a current assumption product, and then premium loads are pretty much the same. So that's what I mean by higher policy charges.
I mean, you're telling me basically, if I'm understanding you, that's where their carrier's making their money. So therefore, if the market goes up or down, they don't care. They're making their spread already.
Exactly. Yeah. Because remember, if the market goes up or down, it really doesn't matter because they're pushing all that risk off to someone else. So it doesn't make any difference to them. All they're trying to do is afford the ability to offer the upside, and as long as the price of that upside doesn't cost too much, they can still do it. So let me give you an example. The 17% cap you're talking about, that might cost, let's say ballpark, 7 to 7.5% to provide that. So if they're only earning 6, but it costs them 7 to 7.5% to provide that 17% cap, they got to have more policy charges to afford that. So rule of thumb is 12% cap costs about 5.5%. And so when you're looking and you say, well, this carrier that has 17% cap, are they earning more in their general account than a carrier that has a 12% cap? Probably not, right?
No, we're all fishing out of the same pool.
Exactly. So we're all fishing out of the same pool. And are they trading with different counterparties to afford those derivatives? No, it's all the same counterparties. So basically all the ingredients to the soup are the same, right? So the only way that there's a difference is if they do some sort of trick with crediting interest, which some carriers do, or they've got higher policy charges for that 17% cap. So the allure of the 17% cap is really smoke and mirrors. Over the long term, those two product performance, cash on cash, those two things are going to converge. The only difference is right now the 17% cap charges you more and gives you more upside, whereas lower cap products are going to charge you less and give you a little bit less, but on a net basis, they could end up being exactly the same.
Well, I guess if I thought the market was going to be sideways for a little while, I would probably desert a 5-year point to point, because the current assumption might be just as good to stay in.
Sure, yeah.
So,
yeah.
Well, that blows my mind. When we're talking about things like this, I think we come to a place where we go, wow, do I need to know the mechanics this deep? And I'm saying I may not need to know the mechanics this deep, because we're talking about actuarial science issues here now. But my thought is, you got to have an understanding of where to go. And I suggest when we're reading like articles that I write, blogs and articles that Bobby writes, these are the industry guys, myself, Bobby. I hope I don't mind putting myself in your little world there, Bob.
Please.
But when I do this, I want to be able to actually have an opportunity to explain to our guys and gals that are in our business, our advisors, here's some of the things that we're looking at.
Right.
And when you hear people speaking negatively about this product, and by the way, there's a lot of negativity about it as well, I want to say, is it warranted?
Yep.
And what we're talking about today is not so much that it's negative, it's just that it is what it is. Are you aware of these mechanics?
Yeah, and what I found is that you can't, it's almost impossible to sell the product and be completely accurate on all your statements without knowing some of the mechanics. And I think the carriers have done a pretty poor job actually of explaining that. So I would say, yes, we're talking about technical things, but the reality is this is a complex technical product. And at the end of the day, you're selling, to put it in layman's terms, you're selling a current assumption product with a bunch of derivatives exposure. And if you don't understand the basics about derivatives or the basics about pricing or why this is different from other products, I'd argue that that's something you absolutely, as part of your practice in becoming a better salesperson, you should know that, because in my experience of positioning these products, the more you know, the better.
There is no way the vast majority of our advisors understand derivatives. I can tell you that right now.
Yeah.
I mean, first of all, let's do the first half. Non-FINRA advisors are not going to have any clue what you just said on derivatives.
Right.
And then the people that are securities that do play in our business are going to be, maybe they'll know the semantics, the language. I've heard about it. It's on the internet. But I mean, they're going to be good. When they watch this show, they're going to be Googling derivatives for the rest of their lives. I have to say, to me, that's an issue.
Yeah.
And so how do I educate? Well, maybe, do you have a piece on this?
I do actually. I have a white paper on my website that covers a lot of the basics on derivatives.
Would you like to give it to us?
We'll see if we can work out a deal.
We'll try to. Hey, if he does, write me at thebiz@brokersalliance.com or call me for it, 1-800-290-7226, extension 147. If you're going to email me on the derivative thing, please try to do it in a sentence. We'll be right back. You've been listening to the Business Insurance Zone, the talk show that talks about insurance in your practice. You can write us at thebiz@brokersalliance.com or call me toll free, 1-800-290-7226, 147. Bobby and I will be right back after a word from our premier sponsor, Brokers Alliance, one of the leading authorities and distributors of insurance products in the country.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high-definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant, insurance columnist, financial color commentator, and in my own eyes, interviewer extraordinaire.
I'd agree.
Well, remember, thanks a lot. Remember, before going forward with anything we're talking about, and we're talking about derivatives, you better talk to your CPA as if they'd know, the attorneys, and of course your broker-dealer compliance department. Wow, I'm going to get a catch for that. Before you move forward with anything, you can get quotes or questions on life insurance, DI, annuities, LTC, group pension plans. Just call 1-800-290-7226, extension 147. It's not what I know, it's who I know. And that's why I have Bobby Samuelson, life insurance industry consultant, and tick off a lot of people today. I mean, we're going to talk about some things today that it shouldn't be controversial.
No,
honestly, what we're talking about shouldn't be controversial.
Should not be controversial.
But I promise you by the time the show airs, it will.
It's fine with me.
But that's good, because what we want to do is we want to mix it up and make sure everybody knows what they're selling, which I doubt very much after this show anybody's going to understand that. Well, let's just say first, before I should say this second segment should be brought to you by your E&O carrier, because you're going to need a lot of it. Bobby, let's talk about this, because I want to make sure we understand. I mean, for example, as soon as we're done with this show, Steve will be trolling the net for everything derivatives. I promise you, I'll be doing that. Hoping I can explain it. I'll be looking for your white paper too. When we're talking about index, I mean, it's so popular, and the theory behind it looks very alluring.
Right.
Principal preservation. Now, just talk about this, because I want to talk about this. Every time I bring it up, I get hate mail. Preservation of principal on the basis of the crediting of zero in a bad boy S&P year.
Right.
But I still have bills to pay. So there's no such thing as preservation of principal ultimately, because they still have to pay COIs,
yes,
front-end charges, comp. All those things are still in there.
Yep.
And I was looking at the S&P 2000, for the 2000 to 2010, because we had 4 loser years. Mm-hmm. And I looked at the 2001, 2, and 3, and I'm thinking, well, we didn't lose anything on an index. It was crediting zero. But I had 230 basis point charges every year compounded.
Yep.
Talk a little bit about this, because we're all out there going, preservation of principal, no negativity.
Yeah, so that's actually a really great point, and there are several ways I could kind of take this. The first thing is, let's talk about the allure of that 0% floor and the upside, and that's actually where, so when I talk about IULs, there are kind of 2 ways in my mind to sell this product, and one is as an asset class, and one is for its illustrated rate. And we've already kind of talked a little bit about the illustrated rate side of the house. If we had a whole hour to talk about it, I would prove to you that showing illustrated rates above, in this environment, 5.5% is flat out irresponsible. That right there is going to be the most controversial thing in the show.
Here we go.
So that to me, from a liability standpoint, that's a really big deal. So to me, the illustrated rate side of the house, not only is an illustration meaningless, but if you're going to show one, you ought to be more conservative. And conservative to me is anything under 5.5 to 6%. So the sales side of it really is that upside potential and downside protection, and that's a really beautiful story, because everybody lost money in the market, and investors are not rational. So they sell at the lows and they buy at the highs, and index UL is basically rational for you, right? It gives you that downside protection. It always gives you upside potential. And so to me, from a psychological standpoint, this is a much better package for consumers than anything else in the market, because to some degree it feels like a free lunch, right? It gives you downside potential, 0% floor, and it gives you all this, or downside protection, all this upside potential. Now, to your point about the policy charges. So actually on the plane out here last night, I was tinkering with this idea to actually look at the mathematical ramifications of having zeros for several years. And what's interesting is that as long as the long-term average stays at about what you thought it would be originally, you only lose about 15 basis points of long-term performance on that. So what's interesting is IUL isn't really even that risky, and even though the policy charges come out, as long as you have a 0 followed by a 12, the difference isn't as much as you think it is. It's on average, it's only about 15 basis points.
Well, my question then is, in 2001, 2, and 3, it was 0
That's
3
right.
straight years.
So I ran that analysis too, and actually what's amazing is if you look at that, like I said, even after 3 0 years, as long as you have 3 12 years to get back to your 6% average, you still end up at about a 5.85% net rate after policy charges.
In that 10-year snapshot, they call it the loser decade. Did we actually get 3 12s?
Yeah, you got a few 12s, but no, I agree. And actually what's interesting is you look at the actual data released by carriers, by a carrier in particular, who will remain unnamed, from its actual...
Although if they want to buy the commercial time on this show...
They're not going to want to after what I'm about to say.
Oh, okay. Well, forget that.
So their actual performance of their block of business from 2000 to 2009 actually underperformed current assumption UL. So they actually looked at what they actually credited to their IUL products versus what the industry was actually crediting to current assumption UL. And IUL actually was worse than current assumption UL in the loser decade.
Now that was just that carrier.
That was, well, and this
Are
carrier.
there other carriers in that?
Well,
too as
keep in mind, IUL's only been around really for 5 or 6 years. So this is one of the long-standing big names in the industry, always number 1, 2, or 3. And this is the performance of their block of business from 2000 to 2009. So basically, long story short, the asset class story in my mind is still there. You really do get a 0% floor, and as long as your as long as your average return stays the same. So if you assume a constant 6, even if you have 0s and 12s all around it, your average still is going to average out to about actually a 5.85 is kind of the good rule of thumb. So the 0% floor, that's a real benefit. And even though the charges come out, it's over the long term, as long as you're overfunding the contract, charges are a small piece.
Well, let's go down there just for a second. If I suppress the death benefit in whatever option gives me the lower COI charge,
Right.
and I suppress that down to the TAM recorder, and I mean I squeeze it,
Yep.
and I'm mitigating even, and by the way, if the contract, depends upon the software, if the contract also allows me to drop the death benefit again at distribution, if it allows me to do it, I'm doing it. So let's say I'm mitigating the COIs all along the trail of this. I mean, I'm willing to do it. And by the way, there's one carrier now that will auto-plate this into their contract, which, wow, that's going to be huge. I haven't seen their numbers yet, but if they actually do that for us,
That'd be a great deal.
that would be a great deal. So if I do all that, can I look at, if I'm really doing that, can I sneak up past your 6% ceiling there in your thinking?
Yeah, so keep in mind that the 6% ceiling is a gross number, not a net number. So I'm not taking into account policy charges when I say that 6%. So the answer would be, if that actually happens, then remember, if carriers are making money in the policy charges and you're giving them less policy charges, that means they have less money to spend on your upside, which means your cap does what? It's going to go down because they have less money to spend on the upside. So the long.
Stop.
Yeah.
So just to make sure I understood what you just said. If I took the leading IUL, which is a 17%, and I'm going to assume that what you just said is true, that it's probably a higher charge. But if I suppress their COIs, the cap is still online if I hit it, right?
That's right, but remember, you're talking about 30 or 40 years from now, 20 or 30 years from now, and the 17% cap you're talking about is right now's cap. Obviously, they can change that cap.
So it's current company practice,
That's
not
right.
a contractual cap.
Oh, absolutely, yeah.
Okay, but let's just make sure we all understand that. Everybody gets that in indexed annuities. Caps
Right.
change all the time, every year resets, we get all that.
Right.
But in UL, I think there's a mistake, because I think we have already assumed, and wrongly so, that, oh, by the way, I bought it at 17%, and that means that the
No.
contract will be there forever.
Yeah, so my favorite thing, an agent actually sent me a photocopy of his mother's statement from, oh, sorry, I shouldn't have said that. Anyway, and the cap went from 15 to 13 to 10.5 to 8.25. And he showed me that statement going down, and he said, this is unbelievable. You know, they were at 15, and now they're down to 8.25. So no, the caps are absolutely not contractually guaranteed, and that's why I'm saying in the long term, right now they're marketing caps with spreads like this, 17 up here, all the way down to 10, and in the long term, they're going to converge, especially what you're talking about, which is where at some point the policy charges become a very minimal amount of account value, which means that if they're affording that high cap based on policy charges, and policy charges are way less in the future, then the cap can't stay above the competition.
Well, you're just going into my complete tributary of thought here when I say when I'm doing income, I'm suppressing the death benefit to the ground, to the TAMR regulatory issues, designing it in a non-MEC format, and I'm keeping it in force for the life of the insured.
Right.
I mean, I'm going to do all that. Every opportunity to mitigate costs, which is the biggest one in this case, is COIs. So I'm all in on that. I'm totally in.
Yeah, and that's where, you know, like I said, over the long term, if everybody does that, all these products are going to start to perform very similar. Because again, they're all buying the same bonds and they're all trading with the same counterparties.
I'm always interested, if I'm sitting there looking at the expense loads, I've mitigated that issue, and I'm looking for the middle ground. Okay, maybe the 17% is the extreme cap. And the persons that are subordinating single digits, they're charging less, are they really? I don't know. You know.
Yeah, most of the time, yeah.
Okay.
I mean, yeah.
So is there a middle ground where it says, well, in the middle somewhere is the truth. So if I'm looking at a cap at 10, that's probably going to be a decent number.
Right. 8
maybe at a cap, but my expense load might be mitigated. My COIs might be less.
Right, that's right. And so I would, what you're really looking for here is cost benefit. And so you're trying to make sure that the cap you get is worth the policy charges you're taking. And the best way to do that is just to run all these policies at very low rates. So 3-4% to get an idea of what the policy charges look like. And then say, okay, well, if I need an extra 100 basis points on this contract, to beat this policy over here, because the policy charges are higher on this contract, is that worth it to me? Am I getting a better shot at upside on this policy versus that policy?
You know what I'm going to do, just because he said that? I'm going to take our 5 top IUL illustrated income scenarios. I'm going to run them all at 4 across the board. Everybody be at the same scene. We're going to see where this is out. Basically, we're exposing the actual underbelly issues here of those contracts.
Yeah, and what I love to say is, look, when somebody buys a contract, they're not buying the upside. They're buying the policy charges. Because are you good at predicting future performance?
Oh, no.
No, yeah, me neither. Because guess what? If we were, we wouldn't be sitting here.
I'd be retired.
That's right.
I wouldn't be coming back to work.
And I'd be on Wall Street making millions of dollars.
Yeah.
So where you're not good at it, I'm not good at it. No agents are good at it. That's not their job. So when you show a client future performance, what you're actually selling them is not the performance. You're selling them the policy charges, because the performance will change, but the policy charges do not change.
Wow, that's going to put a whole new issue in my closing ability. What are you getting, Mr. Client? You're getting these charges.
And you get real upside potential, but me as the insurance agent, who knows? And to me, that's a reduction of that, reducing your liability by focusing on downside, by focusing on policy charges, by focusing on cost benefit, and this very intuitive, very beautiful asset class story of upside potential, downside protection in a tax efficient wrapper. That to me is really the way these products ought to be sold. That is the story. That is absolutely the story.
Well, you've heard the caveat. You've heard the disclaimer. You've heard our E&O cover, our back door. I love it. Well, listen, thanks for being on our show, Bobby. Listen, you can watch this show and all our shows on beautiful HD 1080p right on our website, www.brokersalliance.com. As soon as you come on our homepage, click on the on-demand red button. It'll put you into these shows and all these other shows. We'll have Bobby on, I'm sure, again. Listen, you can watch all this on our social network, too, on Vimeo, YouTube, and all the other channels. I'm Steve Savant. That's the Buzz on the Biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.